Hello everyone, welcome to Professor FinTech, where we break down complex financial concepts into simple, easy to understand explanations. In today's video, we are diving deep into the golden rules of accounting, the secret code that keeps every business alive. Did you know that 82% of small businesses fail because of poor cash flow management? Not because they had bad products, not because customers didn't like them, but because someone didn't understand three simple rules. These three rules were written over 500 years ago and they are still keeping billion-dollar companies running today. Stick around because by the end of this video, you will know the secret code that accountants use to keep every business on this planet alive. Meet Priya. She just started her dream business, a small cafe. On day one, she's thrilled. She makes $5,000 in sales. She buys $3,000 worth of supplies. She pays $2,000 in rent. At the end of the month, she looks at her notebook where she's been tracking everything and she has no idea if she made money or lost money. Sounds familiar? Here's the thing. Priya's not alone. Thousands of business owners are flying blind because they don't understand one fundamental system, the double entry bookkeeping system, and it's hard. Three golden rules. These rules were created by an Italian monk named Luca Pasilio in 1494. Yes, 1494. The same era as Leonardo da Vinci. And guess what? These rules haven't changed because they are based on universal logic. Let me show you why understanding these rules is like getting X-ray vision for money. What are the golden rules? Before we crack the code, you need to understand one thing. In the accounting world, every transaction is like a seesaw. When money comes into your business, it has to come from somewhere. When money leaves your business, it has to go somewhere. Nothing appears or disappears magically. This is called the double entry system. Every transaction touches two accounts. One account gets debited, let's call it the left pocket, and one account gets credited, the right pocket. But here's where it gets tricky. How do you know which account goes left and which account goes right? That's where our three golden rules save the day. But first, we need to understand the three types of accounts that exist in business. Imagine your business finances as a city with three distinct neighborhoods: personal, real, and nominal. These are three neighborhoods. Neighborhood one, it's personal accounts. These are accounts of people and organizations, your customers and suppliers, your bank, even you as the owner. Think of it this way: if you can shake hands with it or it can shake back, it's probably a personal account. Examples: ABC supplier accounts, customer account, ABC bank account, your capital account. Neighborhood 2, real accounts. These are accounts of things, assets, and property. If you can touch it, see it, or own it physically, it's a real account. These are your treasures. Example: cash, the king of real accounts. Building, furniture, machinery, land. Neighborhood number 3, nominal accounts. These are accounts of expenses and income. You can't touch them, but you definitely feel them. Every rupee you spend, every rupee you earn, that's nominal. Examples: salary expense, rent expense, sales income, commission income. Now that you know the three neighborhoods, let's learn the three rules that govern them. The three golden rules. Here's they are, the three principles that have powered accounting for over 500 years. Rule number one, the personal accounts, debit the receiver, credit the giver. Think of this like a gift exchange at a party. When you receive a gift, you are the receiver, debit. When your friend gives the gift, they are the giver, credit. Let me show you a real example that will blow your mind. You pay $5,000 to ABC Supplies. Who is receiving? ABC Supplies. They are getting your money, so debit ABC Supplies account. Who is giving? Your cash. It's leaving your pocket, so credit cash account. See how simple it becomes when you ask who is receiving, who is giving. Rule number 2, For real accounts, debit what comes in, credit what goes out. Think of your business as a fortress. When treasure comes in through the gates, debit. When treasure goes out through the gates, credit. Check out this example. You buy furniture worth $3,000 with cash. What's coming into your business? Furniture. It's entering your fortress. Debit furniture account. What's going out? Cash. It's leaving your vault. Credit cash account. The in out rule. That's all you need to remember. Rule number 3 for nominal accounts: debit all expenses and losses, credit all income and gain. This is the easiest rule. Think of it like a video game score. Expenses and losses, they hurt you. Debit the bad stuff. Income and gains, they help you. Credit the good stuff. Let's see two quick examples. Example A, paying rent $1,500. Rent is an expense. Ouch, money going out. Debit rent account. Cash is leaving. Credit cash account. Example B, receiving commission $800. Commission is income. Yes, money coming in. Credit commission account. Cash is arriving. Debit cash account. Here's a pro tip. Expenses are like villains in your business story. Debit them to track how much damage they are doing. Income is like your superhero. Credit it to celebrate every victory. And that's it. Those are the three golden rules. But wait, I know what you are thinking. Practical examples. How do I use this in a real life? Great question. Let's speed run through some everyday business transaction and watch these rules in action. Transaction number 1, which is bought furniture $3,000 on a cash. Furniture furniture is coming in, a real account. It's a debit. Cash going out. It's a real account. Credit. Boom. Entry recorded. Transaction 2. Paid salary $2,000. Salary is expenses. It's a nominal account. Debit. Cash going out. Real account. Cash is a real account. Credit. Done. Salary account debit to cash account. Easy. Third transaction. Received commission $800. Cash coming in. Cash is a real account. Debit. Commission income. It's a nominal account. Credit. Easy. So cash account debit to credit commission account. Transaction number 4. Paid suppliers $1,500. Supplier receiving personal account. Supplier is a personal account. Debit supplier account. Cash going out. Cash is a real account. Credit. Flawless. Do you see the pattern? Once you know the account type, the rule tells you exactly what to do. No guessing, no confusion, just pure logic. But let me give you a superpower, a step-by-step process you can use for any transactions. Here's your foolproof 5-step system. Screenshot this, print it out, tattoo it on your arm, whatever works. Step 1. Identify the accounts involved. Ask yourself, what two things are changing in this transaction? Step 2. Classify each account type. Is it personal, real, or nominal? Is our presentation trick people, property, or numbers? Step 3. Apply the correct golden rule. Pull out the rule for each account type. Step 4. Determine debit and credit. The rule tells you which goes left, debit, and which goes right, credit. Step 5. Record the entry. Make sure total debits is equal to total credits. The seesaw must balance. Let's practice with one complete example using all 5 steps. Transaction. You received $10,000 loan from ABC Bank in cash. So accounts involved. Step 1 is accounts involved. Cash and ABC account bank. Step 2, account types. Cash is a real. ABC Bank is a personal. So rule, cash, debit what comes in. ABC is a credit, the giver. So debit, cash coming, credit, ABC, they are giving. So debit, cash $10,000, credit, ABC Bank account $10,000. So debit and credit are matching. See, you just did accounting like a pro. Common mistakes to avoid. Now, before you run off and start your accounting empire, let me save you from the 4 biggest mistakes beginners make. Mistake number 1. Classifying account types. This is the number one killer. If you think rent is a personal account instead of nominal, everything falls apart. Take that extra 5 seconds to ask, is this a person, a thing, or an expense or income? Pro tip, when in doubt, go back to basics. Can you shake hands with it? It's personal. Can you touch it? It's real. Is it money in or out? It's nominal. Mistake number two, confusing debit and credit. Here's a dirty secret. Even accountants get confused sometimes. That's why we have the golden rules. Don't guess. Always refer back to the rule for that account type. Remember, debit and credit aren't good or bad. They are just positions, left and right. The rule tells you which position to use. Mistake number three, unbalanced entries. This is like trying to walk with one shoe off. Your entry must balance. Every rupee debited must have a matching rupee credited. Think of it like this. Money can't disappear into thin air. If $5,000 left one account, $5,000 must have entered in the another account. The universe demands balance. Mistake number four, skipping the analysis. I get it. You are busy. You want to record transaction fast, but rushing leads to errors, and errors lead to hours of searching for that missing $1. That's throwing up your entire system. Take the 30 seconds to analyze. Your future self will thank you. Which would you rather spend? 30 seconds now or 3 hours later? Why the golden rules matter? You might be wondering, why should I care about these old rules? There's a software for this. And you are right, there is a software, but here's what they don't tell you. The software uses these exact same rules when you click record transaction in QuickBooks or Tally. The software is applying these golden rules in the background, but more importantly, understanding these rules gives you four superpower. Superpower number one, accuracy and reliability. You can trust your numbers. You can sleep at night knowing that if someone audits your books tomorrow, you are golden. Every transaction has a clear trail, no mysteries, no surprises. Superpower number two, consistency. Whether you are in Mumbai or New York, whether you run a chai shop, tea shop, or a tech startup, these rules work the same way. This creates a universal language of a business. Fun fact, a banker in Japan can read an USA company's accounts because we all follow the same rules. That's powerful. Superpower number three, error detection. When you know the rules, errors jump out at you. You will spot that incorrectly classified expenses from across the room. You become a financial detective. Superpower number four, foundation for success. Everything advanced in accounting, financial statements, ratio analysis, tax planning, investment decisions, all of it builds on these three rules. Master these and you have unlocked the door to understanding any financial concept. Remember Priya from the beginning of our video? Once she learned these rules, she could finally see where her money was going. She discovered she was overspending on supplies. She adjusted. 6 months later, her KP was profitable. These rules literally saved her business. Key master these rules and you have mastered the foundation of accounting. Key takeaways. Let's bring it all home. If you remember nothing is from this video, remember these five things. First, there are three account types. Personal, which is people. Real, that is things. Nominal means money in or out. The second, there are three golden rules, one for each account type, no more, no less. Third, every transaction has two sides, debit and credit. Seesaw must balance. Fourth, always analyze before recording. Ask yourself, what type of account is this? What does the rule say? Fifth, total debits always equal total credits. If they don't, you have made a mistake. Here's your challenge tomorrow. Look at any business transaction, your coffee purchase, your salary deposit, your rent payment. Apply these rules. Identify the accounts, determine the debit and credit. Do this for 7 days straight, and I guarantee these rules will become a second nature. Practice these rules daily and they will become second nature. These three rules have survived 500 years because they are built on universal truth. Energy can't be created or destroyed, only transferred. Money can't appear or disappear, only move. Master these rules and you have mastered the language that keeps the entire business world running. From the small shop on the corner to the Fortune 500 companies on Wall Street, they all speak this language. And now, so do you? And that's wrap up on golden rules of accounting. Thank you so much for watching this video. I really hope you found it helpful and accounting feels a little less scary. If you enjoyed this video, please hit that like button. It really helps this video reach more people who need it. Subscribe to the channel and turn on notifications so you don't miss our next video. Share this video with anyone who is learning accounting, your classmates, friends or colleagues, and comment below. Tell me which topic you want me to cover next. Should we talk about ledger, style balance, financial statements? Let me know. Remember, accounting is a skill that anyone can learn with practice. You have taken the first step today, and I'm proud of you for that. Keep learning, keep practicing, and I will see you in the next video. This is Professor FinTech signing off. Happy accounting, and see you soon.